we're going to get straight on with it. And the question that most people asked out of any today was, what on earth's happening to mortgage rates, and particularly around the buy-to-let sector and the mortgage market. For obvious reasons, that's dominating everybody. So this is our take at the Mortgage Home. First of all, I want to go back to the 28th of February. That's a very key date when Donald Trump and Netanyahu decided that they were going to start bombing Iran. And that did change the trajectory for 2026. Over the following 6 weeks, March into April, we saw incrementally mortgage rates rise on average by about 1.25%. So by middle of April, they topped out at about that extra 1.25% higher. Then it stabilized. And as the markets really got the head around the war, where it was going, and what the impact was on the various countries that might be involved or impacted from an energy point of view, then they could, believe it or not, they can quantify that as best they can. And we know it's volatile, and then convert that, in particularly around swap rates and what the cost of borrowing is likely to be. And there, after that, we actually saw rates starting to drop. So where they peaked about 1.25% higher than where they were in February, on average, and again, you have to be generic, they are now about 0.75% higher than they were back in Feb. And they've stabilized at that level. Now, what's the prediction for the rest of the year? Well, if you can tell me what Trump's going to do tomorrow, I'll tell you what's going to happen to rates. So clearly there's a lot of uncertainty out there about what may or may not happen going forward. It looks fairly stable right now. And in terms of the Bank of England rates, it wouldn't surprise me, because they're trying to manage inflation. And of course, there's these upward pressures. So I won't be surprised if the Bank of England rates start to increase later on this year. Not significantly, but don't be surprised if you see a 0.25 or a 0.5% increase on the Bank of England rate. However, right now, I don't actually see mortgage rates increasing or following suit, because there is a disconnect, which I'm not going to get into, between the Bank of England and swap rates and how that impacts on mortgage rates. So my view for the rest of the year is that the rates you're seeing right now, I would use that for your planning for 2026. My caveat is, of course, that everything's open to change given the uncertainty, but that's my best guess right now. And so even though Bank of England rates might increase, I don't necessarily see mortgage rates going up. Of course, if you want to understand what the impact is on rates on you, then just jump on them and make some time with the team, and we'll give you our best response in terms of rates for your particular situation. Okay. Next question is around cladding. It's obviously, I think it came out really from Grenfell disaster and the cladding issues. So we do have a question around cladding and how do you get mortgages if you're on blocks of flats, particularly over a certain height, and the impact on cladding. Sophie, can you really quickly come back on that one?
Yeah, absolutely. So we do see this a lot. And obviously, like you mentioned, Grenfell was a huge trigger point in terms of lenders being very aware of what they can and can't lend on, and whether they would class it as sort of safe. And so the main thing when you've got a property that has got cladding is lenders will ask for an ESW1 form. Now, what that is that it has either had remedial works done to the cladding, or there will be lenders that would lend on a property where funds have been raised and put to one side for the works to be done. So, and sorry, there has to be a date for that work to be completed as well. So the ESW1 form for a property with cladding is what you're going to need in order to get a mortgage through. That's your answer.
Oh, sorry, Sophie. I got
No, you're all right.
my phone went off. I could have sworn it was on silent. I apologize for that one. Okay, Yomi asks, where are people buying right now? Yomi, I mean, that is clearly a very wide-ranging question. And so I can't really answer that because it really depends on what your strategy is. That's one thing that we're seeing. So as a broker that's dealing with 40 or 50 applications a month, so of course we're seeing where landlords are buying. But these landlords have got a whole range of strategies. And so the first question is, well, what's your strategy? And therefore that sort of dictates where the hotspots might be or where the properties are that are getting the better yields. One thing we can say is that no one's buying really south of the sort of Birmingham Bristol line. If you draw a horizontal line across Birmingham to Bristol across England, south of that line, the capital appreciation is great, but pretty much every lender lends on yield. Lenders don't care about capital appreciation. So if you're trying to maximize your borrowing, then yield drives the conversation and drives where you're looking to lend. So if you're looking for holiday lets, then the Midlands right up to the northeast, of course, Scotland and Wales, but there are other restrictions that we're not going to get into today. And clearly it's likely to be more rural. But if you're looking for a more traditional long-term buy-to-lets, then either inner city or more suburbs of Midlands to the north and upwards, we're seeing a whole range around there, and yields of high single figures, 6, 7, 8% yields into double figures, is sort of what we're sort of seeing. So it's more than metrics rather than the geography that we're seeing. So Yomi, I know that's not you wanted to know what street you want to buy on, don't you, to get the next deal, and that's the best answer I can give. Linked to that, Graham Lee asks about holiday let mortgage rates, and again it's very generic, but Sophie's going to try and answer that question about holiday let mortgage rates. Sophie.
Yeah, we obviously do a lot of holiday lets and we see lots of different types in terms of people's strategy within that holiday let sort of sector as well. So what I mean by that is there are people out there that are buying, yeah, 3, 4 bed cottages in the lakes, etc. And when they're on this sort of smaller side, they look and smell and feel like a residential home that somebody would live in. There are a lot more options. So in terms of rates, there are some high street lenders that would lend to that, and as you can imagine, they're a lot more favourable in terms of the rates. It's more competitive rates and products in general with those types of properties. So you could be seeing anything from sort of 4, 4.5 upwards. Now, please also remember anything we're talking about is generic here. So when I'm talking about rates, that is one very small part of the product as a whole. The separate side of that is that, you can see some rates around the sort of low fours. However, they tend to come with fees. And it might actually be that when you speak to a broker and they look at the options, they end up offering you something significantly higher in the rate, but actually there's no fees. And that actually, as a product, is more cost effective if that's what suits you and your particular property you're buying. The other flip side of that coin is people buying larger properties. So multi-generational properties, 6 bedrooms and above, ex-guest houses or old bed and breakfast. It might even been that it was a hotel at once, and now you want to use it as a holiday let, get that on with Sykes, Airbnb, whatever. But that then just changes the rules of the game when we're going to lenders. So there's a smaller pool of lenders that we can approach when it's above 6 bedrooms. That's sort of your trigger point as to what lenders will lend to those properties. Doesn't mean you can't get a mortgage. You absolutely can, changing who we're approaching. You're almost sort of pushing sometimes, especially when it's an old guest house or an old hotel for certain, you're going more down a commercial route, and therefore you're going to see that in terms of the rates and the products that are being offered.
Sure.
So it may well be that you're seeing sort of 7%, etc. And again, typically they would be coming with fees. So have a chat with your broker if you've got something in mind. Don't just assume because it's a holiday let that there's a set rate. It isn't. It will depend on what you're buying, where you're buying it. So is it going to be classed as a holiday let versus SA? But hopefully that sort of gives you an idea.
Thanks, Sophie. Moving on, we often get inquiries from people with adverse credit, and that is an umbrella term that can cover everything from just being a little bit late in making a payment on a credit card to missing your mortgage payments, to county court judgments, to defaults, bankruptcies, IVAs, the more heavy end of the spectrum. And we deal with all those. And quite often, please, if there's someone that has that scenario, never assume it's going to bite you on the bum so that you can't get a mortgage. So speak to your broker on this. So we've had a question. I won't mention the guy's name, but the question is had missed mortgage payments, which is getting more serious, of course, if a lender's thinking of lending to you and you've actually missed a mortgage payment in the recent past. Now, he's saying that those mortgage payments have now been made good again. But Sophie, can you just give a little bit more detail, again, fairly succinctly, about that particular scenario?
Yeah, absolutely. So we do see this, and we see it more often than I think people would think. And so there is always a bit of a scale in terms of lenders and their approach to how they would consider applications. And like you were just saying before, some things are seen as more serious than others. So from adverse as a whole, you've got the very small adverse that they would sort of, turn a blind eye to. So things like, and I'm certainly not saying please just go and miss all these payments. They want you to be as clean and clear as possible. But if, for example, you missed a mobile phone bill and then that was caught up, they probably will not bat an eyelid at that. And then you've got things like unsecured debt. So you've got your credit cards and your loans, maybe car payments, general bills like gas, electric, and being short on your utilities. And then it starts to get more serious where you've got secured loans, mortgages, etc. And then you've got things like IVAs and bankruptcies. So that's sort of the scale in which they would look at it. Now, if you've had a missed mortgage payment, the one thing that they are doing, there are lenders that would lend to you when you've had a missed mortgage payment. That's the first thing. You can get a mortgage. They're going to be asking, when was the last missed mortgage payment and how many did you miss? So the lenders that do lend to people with missed mortgage payments want to know, have you been clear of missed mortgage payments in the last 12 months? That will then open up another load of lenders that we can approach. If you have got them in the last 12 months, there's likely still be lenders that we can approach, but they want to know what status it got to. So one thing I would suggest is have a look at your credit report. Always get a copy of it. It's not your score you need. Your score's actually irrelevant. We can go into that another time, but it's your full report. How many did you get to? So you'll see it's like a traffic light system and it will say status 1, 2, 3, and that's how many missed payments you've had. Now, status 1 is obviously that you've missed one, and the sort of trigger point is if you've gone over a status 2. If you're at a status 3, they tend to want you to have been clear of that for longer, so 2 years plus. So if you've had missed mortgage payments up to a status 2, they usually allow that on a couple of properties within the last couple of years. But if it's a status 3, you're going to have waited till that's at least 2 years old before we can start going back out to lenders. So hopefully that gives you a good idea. If you're unsure, get a copy of your report, speak to a broker, get the report sent over, and they can feedback more specifically on your particular scenario.
Yeah, great, Sophie. That really insightful answer on that one. Moving on, Jenny asks a question about buying flats over commercial. Again, that raises for me more questions than answers, so I'll make a couple of assumptions around this. If the flat is on a separate title to the commercial underneath, so we are only looking at the flat alone, then depending on what that commercial use is on the ground floor, then there are many traditional standard lenders that will look to lend up to 75% loan to value. But the devil is in, well, what's going on that ground floor? So if it's something of a retail nature, then you're probably fine. But if it's something like that's deemed antisocial by the lender, something that is open well into the night, if it's something like a takeaway, or it's a pub or a nightclub or a laundrette, something with maybe unpleasant smells, anything that from a lender's perspective, when they have to repossess and resell, the resaleability is compromised by what's on the ground floor, then I'm not saying that you should steer clear, but you reflect that in negotiation in terms of what you're going to buy, because you are limiting yourself with lenders. And you might actually be restricted to maybe 65% loan to value, for example. So again, if we got that inquiry, we'd get onto Street View, we'd have a look at it. With Google Maps, have a look round it, get a feel for the location as well, and give some view on it. Now, the second point to this was, well, what if it's all in one freehold building? You wanted to buy the flat that has some sort of commercial element underneath it. Now that is a mixed use mortgage, and it's a different category of lender. It's seen as slightly higher risk. And again, generically, you're talking probably around 7% and maybe higher for that type, but they are available. It's a semi-commercial mortgage. And then one final comment that I do see some of our developers, investors get involved with this type of property is that they might title split something like that. So the advantage of doing that is, one, it might add some value to the units, and two, then you can put the commercial to a commercial lender and the buy-to-lets to a buy-to-let lender, which would be cheaper. So again, devil's in the detail as always, but that's hopefully Jenny gives you some ideas there. Sophie, we asked a question here: what loan to value percentage can you refinance to? I think we all know about the 75%, but maybe elaborate on what else can be done out there. What creativity can we get involved in?
Absolutely. So on buy-to-lets, so not just buy-to-lets, sorry, we're talking about investment properties, buy-to-let, HMOs, etc. You can go typically with lenders now up to 80 or even 85% loan to value. So little as 15% deposit putting in on a purchase or on a refinance. If, for example, you've had a property and maybe it's struggled in terms of increasing in value, or it may be that you've taken a product in the past and added those fees to that loan, which has pushed that loan to value up. It may be that you took a 75% loan to value product at the time, and you've added the fees on and it's pushed you up. So they are out there and they are available, which is great. Now, separate to that, just to mention, is that if you did take those products, there are a lot of lenders that, with those products, they're going to have higher interest rates and higher fees typically. So as you can imagine, lower the deposit or lower the equity in the property. That's the situation with those properties. However, they can be really great options for people who are either low on funds to put down as a deposit, or it might be that you've got a property that you're about to do work to, so you want to keep some of those funds to one side and you're not going to be sort of remaining on that. Because the other side to this is, if you have got a portfolio or if you're planning to grow a portfolio, one part of the criteria that lenders tend to look at when they're assessing a mortgage application is the background portfolio and what overall loan to value that is at. Now, a lot of those lenders have a limit of 75%. So you can see that if you're buying properties with a 15 or 20% deposit, it's going to slowly start catching you up if you then go to buy a property or remortgage property and the background portfolio is sat at that higher loan to value. So it's just something to consider. And again, if you're speaking to your broker, they should be explaining all that and going through those options. They are out there. And I think the one thing we can take from that is that people might feel that there's a bit of uncertainty in the market in terms of rates changing. And yes, we've talked about them coming down. But one of the other things that we do see, if there's sort of a bit of uncertainty, especially from lenders' point of view, is they would certainly start to pull those types of products. 75% would be there, but they're not going to be offering those with the lower deposits of 15 and 20%. So hopefully, again, that gives you confidence that the lenders still think it's time to be buying property and investing.
Yeah, great, Sophie. And if you want to, if we've got portfolio landlords on here today with 4 or more properties on there, and you want to know, is my portfolio healthy? And the definition of healthy is something that we link back to lenders' criteria, exactly what Sophie's saying. Then send us your portfolio through, and we'll give you some feedback on it. We'll do the stats. We'll give you some metrics back as to what we define and ultimately what lenders define as a healthy portfolio. So we'll do that free of charge for you guys that are on here today. Moving on, James Fleck. James, thanks for your question. Are there any age restrictions when it comes to getting a buy-to-let mortgage? Well, there's two elements to this. Is the age restriction about when the mortgage needs to be repaid? Now, historically, buy-to-let lenders were really slow at catching on. They wanted you to repay your mortgage by the time you retired, 65, 70, because that's traditionally how mortgages worked. And then there was a penny drop moment in the late 90s, early 2000s that was saying, we seem to be cutting our own throat here. We're asking landlords to repay the debt. So all of a sudden we don't get any interest payments anymore, but yet we're lending it on the basis of the rental income, not your earned income, and the rental income is going to continue. So what the heck are we doing? So we saw lenders over the early 2000s start to allow landlords to keep that mortgage into your 70s, 80s, 90s, centenarians, and the maximum, and this is a challenge I want to lay out to everyone there, can you get to 110 years of age and still have your mortgage? So that's, off the top of my head, the longest you could take a mortgage to. So having to repay that mortgage for retirement, which used to be a mindset of landlords that, well, I've got to somehow, when I get to retirement, sell my portfolio, which of course starts to incur tax implications. Now they're saying, well, hold on, I've got an income stream that is my pension. Why would I sell? And lenders are really all over this and will allow you to keep that portfolio, as I said, in excess of 100 years of age. The other part of that question is, what if you're already in your 70s or 80s? Can I actually get a buy-to-let mortgage? And again, generically, the answer is yes. We do get many people who are retired who want still to be buying, they're active in the market. It might not be for them. It might be more for kids and grandkids as part of a legacy, but still they're actively. So again, devil's in the detail, but we can get mortgages for people well into retirement, but it does depend on your circumstances. Moving on,
this is to add on that.
Yeah, go for it.
It just says is the age restriction talked about on the end and onwards, but the other side of that is on the younger side. Typically speaking, again, generic rules is always exceptions to the rules. You've got to be 21 to apply for a buy-to-let mortgage. 18 if it's your own home, but you've got to have a couple more birthdays before they start letting you invest.
Yeah, good point. Thanks, Sophie.
Worries.
Right, this was probably the second or third most popular question that you guys asked today, which was, should I buy in a limited company or in my personal name? And again, it's a tax-driven question. So again, the strict answer is you've got to speak to a tax accountant. If you haven't, again, just as a reminder, just put into the chat intro to tax accountant, and we'll get you hooked up with our property tax accountants if you don't have one yourself, and they'll be able to answer that limited company versus personal. However, we do have a view you might not be surprised to see. So limited companies with the tax changes, particularly going back to 2016, there was a very draconian change in the tax laws that really fueled the setting up of SPVs, limited companies for buying properties in. And if we fast forward to 2026, they now dominate the buy-to-let mortgage market. The stats are that 6 out of every 10 purchases, certainly last year in 2025, 6 out of 10 purchases were done in a limited company. And that's likely to continue as we go into 2026, 27. So it's clearly there's a reason behind it, where now more landlords are going to limited companies than buying in personal names. And it tends to be tax driven. And there's two elements here. One is that usually our landlords are in the buying properties, aren't they? That you're in growth phase, as I would call it. So you're adding to your portfolio. So what I tend to see as a broker is that landlords have maybe another source of income. Maybe they're employed, maybe they've got another business where their earned income's coming from to pay the bills. And the property portfolio is for the future. They're building up that income, that passive income, but it's not there yet. So therefore, they're not relying on that income now to put food on the table. So if that's the case, then if you've got your properties in a limited company, it's a tax efficient vehicle because you've only got corporation tax to think about. If you're not pulling that surplus, that profit from rent out of the limited company, you don't have the double tax scenario of corporation tax plus personal tax. Because what you can do is any surplus from rents stays in the limited company. Yes, you pay corporation tax on it, but then you can recycle that as your deposit for your next purchase. So it stays within that bubble, within the limited company, but for those purposes. The other advantage that we see landlords buying limited company for is for legacy and succession planning. So unlike in a personal name where once you've left this mortal coil, then your inheritors are essentially acquiring the property, and that will trigger some tax implications. Whereas if you can manage the succession planning and start to bring your beneficiaries on in a planned way with your accountants on board, they can come on as minority shareholders quite often. If you speak to us at the same time, we can tell you where those minority shareholders will stay under the radar, not have to be brought in, or it won't prohibit you or inhibit you getting mortgages, but there'll be a tipping point, usually over 20% shareholding, where those minority shareholders might have to go onto the mortgages. But then if they're of a certain age, and we know that it won't then impact on mortgages, you can start to bring those beneficiaries on as not only minority shareholders, but start to increase their shareholding in a planned way to minimize tax, and ultimately the transfer of those assets move across from maybe one generation to another. As I said, it is a tax question, but that's my sort of view on that one. Sophie, can you answer this one from Zoo? Zoo asks, can a buy-to-let mortgage property be used as a HMO during the fixed period? I've got a feeling he's not going to like the answer to this one, but if you can quickly answer that, that'd be great.
Very quickly, no. So, no, in a more detailed answer, when you apply for a mortgage, you're obviously applying on the basis that you're going to use that property for, and this goes for the lifetime of that mortgage with that lender. So even if you're out of the fixed period, it doesn't change the contract that you entered into with them. So if you applied to a lender for a buy-to-let mortgage for it to be let on a standard AST, with just normal family tenants, then that has to be the basis that you let that property. If you then change the use of the property, so you want to use it as a HMO, for example, there are ways around doing that, in the sense that you can go to the lender and ask for permission, or it could be that you remortgage onto a HMO product, but ultimately you have to use that property for the intended purpose as you sort of detailed in the application when you applied for the mortgage. If they find out that you used it as a HMO, we've had a client recently, very similar, and they've called in the loan. They've needed to make an amendment to their mortgage, and when they've contacted the lender direct, they've mentioned it's HMO. They've then recalled the loan. So they've said, look, you need to move mortgage away. You have to pay all early repayment charges because you're tied in with us, and you need to put it with somebody else. So it is quite serious. But if you're unsure, if you're wanting to use it in a certain way and you want to see if there's a way around it because you've changed how you're going to use it, have a chat with a broker, see what can be done. If, for example, you've got a residential mortgage, it's a property for you to live in, but then you want to let it out, you can get consent to let, you can get permission for things like that. So let us know, have a chat, and we'll see what we can do to help.
Thanks, Sophie. Tony asks, how do I avoid high product fees? We all see them nowadays, and probably one of the highest product fees we see is around a 7% arrangement fee, which sounds eye-watering. And it almost sounds like, well, what idiot person would actually take a mortgage product with a 7% arrangement fee? So in other words, if you're borrowing £100,000 mortgage, it's 7% of the borrowing. So it's going to cost you another £7,000 in product fees to get that mortgage. Who would get that? Listen, this isn't driven out of profiteering from the lenders. This goes back to around 2021, 2022 in particular, when mortgage rates, after Liz Truss and Crazy Kwarteng did that crazy budget in September, and it was so badly taken by the markets that mortgage rates almost tripled in about a month. They went from around 2-3% to 6-7%. And at that point, all of a sudden, your rents are not going to respond that quickly, can you? You cannot increase your rents by 200-300%. So all of a sudden, we've got this mismatch where it looks like your your rents are not going to get the mortgage that you want, because the ICR, the interest rate calculation, does not stack up, because the interest rate that is traditionally used is not going to get covered by the rent, because all of a sudden the rents are really lagging behind. So lenders, because you're their bread and butter, they have to respond by innovation, and they brought out products with incredibly low interest rates. I think there's still one out now with a 2.9% interest rate with a 7% arrangement fee. And the reason is that if as a landlord, you have to maximize your borrowing. You really need 75% loan to borrowing, whether that is for a purchase or you want to pull that equity out because you've got an amazing project. You've got a BMV property deal with a 30% discount that you're desperate to get the money out of your property. Then are you going to pay 7% arrangement fees to get a deal that's going to give you a 30% discount? Well, I guess I would do it. I'd do it all day long because it makes financial sense. And lenders get that if the landlord really needs to maximize the borrowing, then they've had to produce products, because they're bound by regulations that they have to do this ICR calculation, this stress calculation. So if they use a low interest rate, it means that they can be more generous in what they lend to you, because the product fee is outside of the calculation. So they get all the profit from the arrangement fee, and it's a loss leader on the interest rate. So they're being quite innovative. Now, how do you avoid high product fees? Most lenders will offer a range of products where you've got these really low rates with high fees. And Sophie touched on it earlier. They've got one with higher rates and really low fees. And if you're not trying to maximize your borrowing, it's likely to be more cost effective to go for the higher rate and lower fee. So look, it depends on your circumstance and how much you want to release in terms of equity, but there are choices of products, and that's potentially how you look to avoid it. Sophie, GS asks a bridging question. And they're looking, I'm guessing they're looking to buy a property that they want to use for social housing. And they're saying, is bridging available for such properties?
Yeah, good question. So bridging is available for all property types. Bridging is not a fussy product in the sense of what they will lend on. If you came to us with a wheelie bin, if it's stacked up in terms of figures, they'd probably lend on it. So from a bridging point of view, they're not worried too much about the security, but more in the sense of how you're going to repay that bridging loan. So bridging is short-term finance. It's absolutely got its place in the market. If you're buying something at auction, you need to move quickly, or it might be that it's not habitable. You need to do a lot of work to it. And there's other scenarios as well where we will use bridging. But yeah, if you're planning to use that property for social housing, that is not an issue. The biggest thing with bridging is how we're going to get you off that bridge. So bridging typically is anything between sort of up to 12 months. Some will go up to 2 years, but usually around 12 months that you can get a bridging loan for. And if you go over that bridge by a day, a month, a week, it starts to get really, really serious in terms of the fees and the costs of staying on that bridge beyond that term that you've agreed with them. So the biggest thing you need to be sort of working out, or your broker certainly needs to be working out, is we can get you the bridge, but how do we get you off it? I know, this week actually we've had a client that really, really wanted to get a bridge. We could get them a bridge easily, but we knew that getting term finance because of the situation of the property itself and to get them off the bridge was not possible. So in that scenario, we would not get that person into the bridge because it's not responsible lending. So have a chat with the broker, understand what it is that you need the bridge for, because if it's just because it is a social housing property, that would not dictate us going to a bridging lender. But if there's other elements around why you need in the bridge, then maybe, but the social housing element should not be an issue at all.
Thanks, Sophie. We've had quite a few similar questions around bridging, in respect of what are the best rates in certain scenarios. Below market value deals are quite often is where bridging comes in. If you're getting a significant discount on a property, then bridging is one of a two-step strategy quite often. that you'll get into bridging so that you can add some value to the property, and then you come out of bridging that allows you to then extract the equity from both the discount that you've negotiated plus any added value that you've got. Now, here's something that you might want to write down in relation to bridging for all you guys that are investor developers, because it's a key formula that a minority of bridging companies, but a decent minority, might work towards, because traditionally bridging is still restricted to 70% loan to value. But here's the exception that is really powerful when it comes to below market value deals or with discounts. That we've got a clump of lenders, bridging lenders, that will lend up to 90% of the purchase price. But here's the thing, it cannot be more than 70% of the open market value. So there's two parts to this calculation. They will lend on the lower of those two figures. So it's either 90% of the purchase price or 70% of the open market value. So if you've got an amazing discount, it might be that you can get into the bridging finance and only put down a 10% deposit. And I know we've actually got people on the call today where we've managed to get people into a purchase with no money down whatsoever. Now, that's a little bit of a tease because that is so niche and there's so many caveats to be able to do that. I wouldn't want to suggest that is normal, but there are bridging companies that would even allow 100% of the purchase price in certain development scenarios. So if you're doing a development in bridging and you want to look at some creative ways, then do book some time in to understand whether you and your property and your project might be eligible for that one. Sophie, if moving on, is funding available for an FIC? We've got a bit of an acronym, F, Family Investment Company. You might want to just explain what that definition is and then go on to understanding what lenders are looking for.
Yeah, sure. So, family investment companies are just what they sort of would explain as it's a limited company, but it's been set up in a specific way in the sense of adding on shareholders, family members for succession planning, and allowing that to be passed over to maybe children, etc., in future years. So from our point of view, it's just treated as a limited company, purchase or remortgage. And so what we would need to know is the split of the shareholding and how that has been set up. Now, the best thing you can do is have the conversation with a mortgage broker before you set up the limited company, or have that conversation at the same time as having the conversation with your accountant, or if you're setting that up yourself. But usually, especially in the family investment company side of it, it's usually dictated by an accountant how best to do it. Now, you really need to be speaking to an accountant who is fluent in working with landlords, people who are buying property, people who are investing. And if you've got a specialist tax advisor that is really, really clued up on property side of stuff, they will understand the impact of setting up a limited company in a certain way has on applying for a mortgage. Now, it might be that they advise you the best way to do it is husband and wife go on as directors, and then you've got 4 children and they can have 20% each, and then you've got 10% each maybe as the directors for the remaining of the 100% shares, which is great from a tax perspective, I'm sure, as they've advised you to do that. However, from a mortgage perspective, if you've got, children who are under the age of 21, some children we've seen as young as 5 going on as a shareholder of a company, which is great for them when they grow up and to inherit this property and this investment company. However, from a mortgage point of view, when they've got majority shares within a company, it starts to cause issues. So again, very, very generic rule is if there is a shareholder that has got below 20% of shares, they can be ignored. And one thing that the lenders would say is they would then ignore them, especially if they are family members. However, there are so many different rules around this that some lenders want the majority of shares to be held by the directors. So it may be that actually you've got that many children, you've got 6, 7, 8 children. If they've all got even 10% shares each, you can imagine, then all of a sudden the majority of the shares are not with the directors. So it is complicated. It can be done. And so it's just about having that conversation. What does it need to look like? How can we find that balancing act? It's not a case of don't put them on there, but put them on there in maybe a slightly different capacity. And understanding the implication of that. So yes, you can buy property in a family investment company, but it's about getting that structure right.
Yeah, thanks, Sophie. Next question from Elena Jeffers. Elena asks, she wants to get involved with others to buy a house. Now, that strictly isn't mortgage related. It's finding a joint venture business partner, I think, is where Elena's coming from here. But of course, we see so many inquiries coming in from people that have joint venture partners, and I want to just expand on what I mean by that. Because lenders will respond differently depending on how that joint venture partner wants to be involved in that partnership. So, first of all, joint venture partner sounds very official, very business-like. I've done joint ventures with family members, with siblings, with my brother. I've done a few properties with a neighbor. I bought 12 properties using neighbors finance. So, looking in your own network, it is a great hunting ground to start with. A lot of you on the call today, I'm sure, have come through the sort of property education courses. And you'll know there that there's like-minded people in the room there that may have the money, but don't necessarily have a lot of time right now. So maybe if you've got the time, you can hook up with those sort of people and come to some sort of arrangement. Now, assuming you do find that joint venture partner and you're looking to purchase a property, then the next question is, well, how will lenders respond to that? And again, there's so many permutations of this answer. I'm keeping it fairly generic. I'm going to put it into two camps. First of all, if that joint venture partner is happy to go on to the mortgage with you, then that clearly is going to open up most lenders in the market. That's pretty straight. That's just two people with a common interest. The lender can do due diligence on both applicants, and it's not an issue. You're not going to be restricted with lenders. But what I see more often is that you've approached an investor to borrow £100,000, and that investor does not want to get involved and tangled up with a mortgage application. They don't want to be giving over credit reports, having credit checks done, passing over their income details. They just want to lend you the money and perhaps get some guaranteed interest back from it. That's, for me, the most common relationship with that joint venture investor. They want to give you the money. They want to stay in the shadows. Job done. Now, the problem there is most lenders say, well, we can't see where the money's come from. We don't know the source of the money. We can't do any due diligence on that joint venture partner. Therefore, we're out. We don't want to lend. The good news for us as brokers that we have some key relationships with lenders that understand that commercial relationship, and they still will look and have appetite to lend to you, even though the money is coming from a third party that's not going to be on the mortgage. And that what you have got is a legal document saying, I've got 100 grand from Mr. or Mrs. Smith. I'm borrowing it for 5 years. I'm paying them an interest rate back at 7%. This is the deal. And this lender will go, right, I get that. I understand it. And will then look to lend on that purchase. So, yes, they're out there, but you've got to work with a broker that understands that scenario. So hopefully, Eileen, that does answer that question. But again, come back to us if yours is slightly different to what we've just mentioned. Now, we're coming into the last 10 minutes. If you've got a burning question now, then put your emoji hand up, either unmute and just, make yourself known, and we'll make sure we answer your question. If not, we've still got tons of questions to get through in these next 10 minutes. And the last point is, Aaron, will you re-put, if you haven't done already, into chat the link to our online diary? If you've got something, if we run out of time, you've got a question that you want to ask, or as usual, you want to ask it and we've just finished, or it's so niche or personalized that you're a bit shy of raising it here in a public forum, then just book some time in. It's not going to cost you anything. Book some time in with the team and we'll answer your question confidentially. Okay, we're going to get on with it. Sophie, Fiona, I know Fiona's on this morning. Fiona Black, she asked about mortgages on properties with low EPC ratings. We know that the government's out with consultation on that right now, but there are a set of rules in place. Can you just expand on that for Fiona, please?
Yeah, absolutely. So if this is for an investment property, so not a property that you're going to live in, then the EPC must be an E or above. That is the rule. It has to be an E or above and it has to be in date. So if you're planning on buying a property, it should absolutely have an EPC that's in date, not necessarily an E or above, but it should have one that's in date. If it's a property that you're remortgaging, check that it is in date. And you can do that really easily. It's a government website, EPC checker. You put your postcode in, find your property. You will have to bring that up to date before you apply. There are still lenders putting incentives out to try and boost EPC. So it used to be that incentive wise, they would give either maybe a slightly lower rate or slightly better fees on products. If your EPC was an A, B, or a C, a lot now have changed that to just an A or a B. Green products they're called, slightly better rates or slightly better products in terms of the fees on there. The only exception to all of this is if your property is exempt. So what you again can have a look at if you're exempt from updating your EPC is there are a list. I think there's something like 7 reasons, and it is things like if the cost of bringing your property up to date to bring it in line with the EPC is above a set amount, you can actually get an exemption. So it doesn't have to be an E or above. And there's a few other different things. It might be that it's a listed building, you therefore can't make amendments to it that you would normally because it's listed. Things like that. Have a look. If you just Google it, it's on the government website. So the only exception to that is that you have got an exemption, or if it's an E or above, then you'll be fine.
Thanks, Sophie. We've got a great question here from Rupert Smedley. So Rupert's asking, how easy is it to scale up? Now, I think that's a really great question because there could be a misapprehension when you start off as a landlord that why on earth would lenders start lending you into the hundreds of thousands and then into the millions when you're on a salary of 30,000 quid, for example? Well, first of all, you've got to disconnect your earned income with the finance you're going to get for your buy to let, because as we've said before, and as most of you on here know, that the borrowing is based on the rental income, not on you as an individual. And so that's the first thing. So yes, you absolutely can scale up. Now, our largest landlord has got over 200 properties and is still actively probably buying 30, 40, 50 properties in 2026. And there's plenty of lenders out there with appetite to lend. Now, there's a couple of extra points I want to throw in. There is something called aggregate lending. So each lender will have a maximum exposure limit per applicant. So when you go to a particular lender, let's say Aldermore, we might have all heard of Aldermore or Paragon, they'll have a maximum of somewhere between 5 and 10 million pounds worth of lending before they say no more. We think our exposure to you as an individual is now maxed out. But that's pretty ambitious, isn't it? 5 to 10 million. And guess what? That's one lender, and we've probably got 20 lenders to go to. So in terms of scaling up, how ambitious are you? One final comment on the pace of your scaling up, because if you own one buy to let today and you want to buy your next purchase is 20 all at one go, don't be surprised if a lender goes, we don't think you've yet got the experience to go from one up the gears. You're going from the first or second gear to 6 and you're putting turbo drive on at the same time. We think you're going at too fast a pace. So you've got to pace yourself as well. But here's one example. We've got a landlord at the moment. He's got 13 buy-to-lets, 1-3, and we're getting him finance to add 60 to his portfolio. So he'll have 73 when it completes. So, once you're deemed as experienced, and certainly, having 10 plus properties definitely ticks that box, then going up the gears at a faster pace is easy. So I think for the most ambitious landlord, we haven't found any restrictions from lenders. Asif Chowdhury asked a question, Sophie, that I want you to answer if you will. And it sounds really technical, but so if you would interpret this into layman's terms, what's the impact of Basel 3.1 rules on getting mortgages? So yeah, there's a few smiling faces. What on earth is going on
What
here?
does
So
that mean? What does that mean?
let's turn it into English because
Yeah,
there's a genuine.
there is.
Otherwise, I wouldn't have even asked the question. But there's a quite a wide ranging impact here.
Yeah, absolutely. So the rules around this Basel 3.1 essentially is a directive for the lenders that so obviously lenders are bound by lots of different rules. Is the PRA, the FCA, all the different regulators out there, and they dictate to lenders around their lending, what they can and can't do, and what stipulations they're going to put in place, depending on what it is that they're wanting to do. Now, this Basel 3.1 is fully relating to capital adequacy. And what I mean by that is when they lend on certain types of products. And actually, it's a funny that this question's come up. I've had a meeting this week with the head of operations and the head of products at Aldermore, and they were talking about this in the sense of we push lenders to talk to them about what they're bringing to the market, what they're currently doing, and we want to see them doing, because we fight for you guys to get more products out in the market, change of criteria, etc. And this particular change in rules is directly related to how lenders lend when they're lending against holiday lets. Now, what this means is for every pound they lend out on a holiday let product, so somebody is buying a holiday let property and they want to borrow £100,000, this new rule means that the lender has to hold £1 for every pound they lend on file. So in the bank, they must have the capital adequacy at 100% for holiday lets. And this has actually put Aldermore off coming to market with holiday lets. It was something they were a little nervous around anyway, and they were thinking about, but it wasn't forefront of their mind. But it's certainly put it on the back burner for them because of this rule. It hasn't had an impact on anybody that is currently lending on holiday lets. They're not backing out of the market or anything. But in terms of what does Basel 3.1 mean, that is what it relates to. And it's around how much funds they have to keep holding on account for what they're lending against, which is interesting, and it shows how they make decisions and how it can go, well, actually, we were going to do that, but we're going to have a lot more funds than we're currently holding. And so you can see how they're going then down a different path from that.
Thanks, Sophie, for putting it in layman's terms. What Sophie didn't also say is, because she's a humble individual, is that the director of product development at Aldermore has asked Sophie to work with her on shaping the future of Aldermore's products. So,
Yes.
you'll be the first to know. Maybe we'll hear before they go live, Sophie, about any innovation that Aldermore are coming out with. But yeah, that's a great answer. Again, just briefly, there's a lot I know didn't join right at the start and may have missed and want to hear and see the full recording. So, Aaron, if you're still on, would you just re-put the link to our YouTube channel? And if you guys want to, if you haven't done before, if you click subscribe, then what it means is we ain't going to bombard you with stuff. But what it does mean is when we upload any content, and in particular the full recording of today's session, you'll get a little prompt, a little tap on the shoulder to say it's up on the channel, and you can just go onto our YouTube channel and then watch the full recording at your leisure. Right, Ben asked a question. Is now the right time to buy my first buy-to-let? Well, I would absolutely say it is. I mean, the right time to buy was, of course, 25 years ago. The second right time to buy is today, 2026. And it's not just, I would say that, wouldn't I? Because I want to do the mortgages. But the genuine reason I would say that is that over the last 3 years, landlords have had it really tough. And in particular, when I talked about mortgage rates increasing in 21, 22 from that 2 to 3% to 6 to 7%. So as you can see, the mortgage rates go up here, and it's taken rents a good 3 years to get up to sort of parity. Um, in my world, I saw that parity happen, that balance redressed around a year ago in 2025, when finally a healthy norm was established again, that rents are now catching up with those higher mortgage rates, and landlords were finally not only breaking even, but starting to make profits again. And they didn't have to, or weren't now forced to leave the market because of the mismatch with mortgage rates and rents. What we've seen in addition to that is that rates have not only come up to here, but rents have come up to this level, but mortgage rates have started to drop again. So we've definitely got a very healthy market now, in my opinion, for the buy-to-let mortgage market. So I do think it's a great time to buy in 2026, Ben. So if you want us to help you get on the property ladder, like I say, we do help landlords with 200 plus properties. We're delighted to help you at the start of your journey with your first one as well. Sophie, we are running out of time, but we've just got a couple I want to get through before we finish. And we've got Ben coming back on you with a question. Ben, you want to just unmute yourself if you want to come back? If it's you were asking about the first buy to let, Ben.
I don't know if you're just giving a thumbs up from the answer.
Oh, it's just to answer. I thought
yeah,
you wanted to ask.
It wasn't waving at you, I don't think.
Oh, right. Okay. Thank you. Okay, so Charmaine asks, what's the best way of getting equity out of my property? That's a really quick, easy one for us.
Yes, absolutely. So a few different ways. And again, it will depend on your current circumstance. So if you've got a property with no mortgage, excellent, great, remortgage, pull that money out, go to hopefully just a normal term lender if it's a standard property. If you are tied into your current deal and there's going to be fees to get away from that, it might well be that it's worth paying those fees and we still remortgage to a new lender. We would work that out. A lot of lenders would offer what's called a further advance. So it might be that you're tied in with your current lender, but you can take a second mortgage with them. It means you don't pay any fees. If you're on a lovely low rate with them, you don't lose that either. And you can still borrow extra to release equity. The other thing is if that's not possible and the lender you're with is being really tight and they're not going to give you any money, or actually maybe that you, for example, you're with a high street lender but your circumstances have changed and you no longer fit with them, so yes, you can keep the mortgage you've got with them, but they will not allow you to borrow extra. You can look at second charges as well. So there's so many different ways of doing it, and it all again just comes down to your circumstances, but we can run through that, look at the best option, most cost effective, and what's going to give you the most out of it to start investing.
Thanks, Sophie. We are out of time. I'm going to ask and answer one last question. We had it asked by about 2 or 3 of our people on today, and it's actually about life insurance. And the question in essence was, is life assurance essential when you're getting buy-to-let mortgages? Well, there's a couple of answers to this. One is that back in the old days, mortgage lenders used to make it mandatory to take out life insurance. And as we've all seen, that disappeared a long time ago. So the onus is now on you as the applicant as to whether you think you want life insurance or not. You will see on a lot of mortgage offers that they refer to life insurance and they'll quote even figures, but it's not mandatory. So that's the first comment I want to make. However, here's the thing. If you're on your property journey, and I guess most people on this call right now are, if you've already got to your property goal, I'd be surprised if you're on this call and still trying to learn about finance. So I'm going to assume that you haven't reached that property goal yet. You're either starting like Ben, getting his first property, or you're somewhere on your journey. And you've got this property goal of achieving, I'm going to say, £100,000 a year of passive income by a certain timescale. And you need 10, 20, 30 properties to get there, but you're only at a certain part of that journey through. And then all of a sudden, something out of left field happens that completely derails that plan. Now, that might mean you literally get run over by a bus and you're no longer on the planet. And in other words, then what happens to that property plan? It's in tatters, or there's some serious medical issue, a critical illness, a serious illness that just means you cannot carry on with your property plan. Either way, it's completely compromised. You're no longer going to hit those property goals, because once you get to your property goals and you've got that 100 grand a year, I don't see the need for insurance. But whilst you're on your journey, you got to protect the journey. That's my opinion. So, but from my view, is you need some form of life insurance and protection for that journey. Whether is it 5 years, is it 10 years? Because if something happens, the whole point of life insurance is that you never want to use it. No one wants to use that product that they're buying, which is really unusual. But it's there for if something really goes badly wrong. And what that does is it accelerates that you to your goal. Because if then there's a lump sum comes out, it can clear the debts, and that means your loved ones, your beneficiaries, or indeed you, if you're still here, but you've actually got a medical condition or a serious illness, you've now got perhaps a portfolio that's completely debt-free, maybe, to either pass on to your beneficiaries or for you, so that passive income instantly goes from where it is currently significantly higher to meet your changing needs. So if you think that resonates with you, and by the way, it can be put into a trust. We do that here where we put it into a trust. It's got an envelope that means it's completely tax free. It avoids any tax whatsoever. It does not form part of your estate. It's another sort of question. I don't want to get into too much detail, but it's very simple if you get advised life insurance. So if you want to know a little bit more about that, you want to know how you can mitigate those particular risks, how life insurance can be tax-free if you don't think it is right now, then just before we finish, just put into the chat life insurance introduction, and we've got a lady in our office called Yvonne, who will be delighted to have a no obligation conversation with you and just give you some facts and figures and information so you can make an informed decision on that point. At that stage, we are over our 60 minutes. Thank you so much to everyone that stayed on for the full hour. We really appreciate it. We're going to do these, we're so well attended. We're going to do another one in around a couple of months. So obviously you're on our mailing list. You'll get a little tap on the shoulder at that time. So thank you so much for your engagement. Thank you so much for all the questions that makes it such an enjoyable hour from our side to try and support. And other than that, enjoy your day, have a fantastic time, and we'll see you on the next Q&A. Have a great one. Bye now. Bye.